Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis and Daniel Murphy of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
Oh, I'm doing unbelievably well.
So good to see you.
Yeah, same here.
Daniel, how are you today?
I'm doing outstanding. Thanks for asking, Cynthia.
It's wonderful to have you both on the show, and wow, what a big show that we have today. We're going to be covering things like the Secure Act, its tax implications, new IRS rulings, IRAs, RMDs, and how to plan your taxes. So guys, I've been hearing a lot of talk in the news lately about the Secure Act. Stewart, what is that exactly? What is the Secure Act?
Well, so the Secure Act is actually something that I like to claim a little credit for, and now I'm trying to run from it. But back in 2019, we actually had a really neat meeting with both of our senators, staff, and a few of our Congress people here. And the Secure Act, what it was intended to do was to delay required minimum distributions and a few other things. But when we went back there, Cynthia, to D.C., the meetings went really, really well because, you know, we were seeing this was right in the middle of the impeachment trials. It was a big disaster, but the Secure Act itself had a lot of implications we didn't expect.
Wow, okay.
Yeah.
So what actually changed, if you don't mind, Stewart? Can you give me the details on that?
Well, this is kind of Dan's specialty, so I'll hand it over to
Dan. I'm going to put you in the hot seat.
I mean, Cynthia, a lot of people understand and know that it delayed out the actual, time frame as far as being able to take, the actual, so you could defer out those RMDs. It was another year and a half, actually, that it added. So everybody knows that, and they were excited about it. So it moved from 70 and a half now to 72, and everyone got excited about that. But what they didn't really understand, and RMDs, by the way, obviously stands for required minimum distributions.
Okay.
So people got pretty excited about it because it allowed them to take that deferral even further, and they didn't have to take that money. We run into a lot of clients that actually don't really want that money, right away. And so it definitely allowed them to do quite a bit. But something that typically is lost with the Secure Act is that people forget that it took away the stretch IRA. And that was quite, quite an amazing thing that people were able to use before, this actually happened. And, you kind of liken to it if Johnny, ended up having a grandfather in his 80s and grandpa was worth, $1 million in his IRA. Back before the Secure Act actually happened, Johnny would be able to inherit that $1 million, and there really wasn't any need to have to take that right away. It would be based on Johnny's age. And so if he's in his 30s at the time, gives Johnny plenty of time to be able to take that money. And now with the Secure Act, unfortunately, Johnny's going to have to take all of that money within a 10-year period of time.
Wow.
So it really kind of causes some really big issues. Perhaps in the office, we kind of call it a tax bomb that could go off at some point. And so making sure there's some proper tax planning and understanding, the ramifications of that Secure Act and what it does and what it doesn't is really important.
Absolutely. Thank you, Daniel.
Yeah,
Stewart?
Yeah, the elimination of the stretch IRA was not part of what we were asking for. I mean, we really wanted to make sure, Cynthia, that we could delay required minimum distributions. There were a couple other things it did with the ERISA protections and so forth, but the stretch IRA is a huge issue. And as most of you know, we have a tax office here where we not only consider investments and finances, but also taxes as well. And the tax implications are pretty dramatic.
Absolutely. I have to ask you, what about the new IRS ruling that I've been hearing about?
Yeah, this is an absolute disaster here. So the uncertainty that we've seen over the last year or so with the Secure Act is basically regarding required minimum distributions for non-eligible members. So for non-spouse beneficiaries, essentially, they had to, the understanding was that they would have to dispose of this within 10 years. We knew that. That was clear, like Dan said. But Cynthia, what we're finding out now is that the new ruling with the IRS is saying that essentially now those people have to take RMDs as well. So let me kind of delineate the difference. Before, we had people that said, hey, we don't want to take our RMD this year. We're going to wait until year 2 or 3 or 4 to start it, because it doesn't matter, or it didn't matter, whether you took it each and every year. It just had to be exhausted within 10 years. The new IRS ruling is completely making a mess of it, and they call it monitoring your concurrent life expectancies, whatever the heck that means.
Wow.
So there's a dual age requirement now inside monitoring the RMDs, and it's just adding way
Wow.
too much big brother, way too much complexity to it. So, IRAs, people know, we've been suggesting for years that people have some real tax efficiency, right? Cynthia, I'm telling you now, it's even more important to take action and to have a real tax plan and to create some more efficient structure for your retirement.
Sure. So how does this apply to the Roth? Dan, can I put you on the spot?
Well, the Roth is one of those important things where we can defer out that money and it's all tax-free. And so we have a lot of tax, complications going on in the normal IRA, and the Roth gives us the opportunity to kind of take those funds, defer them out, and now when we pull that money, it's completely tax-free. So it's a really nice advantage within the actual tax, Roth account in general.
Perfect. Stewart?
Yeah, and the IRS has basically come out and said that the Roth owners were considered to have died before their RMD age, which is a weird nuance. It doesn't really make a ton of sense, but there are no required minimum distributions under current interpretation. So you can basically wait till the end of the 10 years. So with the Roth, just let's make sure we understand this. With the regular IRA, now you have to take required minimum distributions each and every year for an inherited IRA, a non-spouse IRA. And then at the end of that 10 years, there's this huge potential balloon payment, because remember, the RMDs will not exhaust it within 10 years. So when people are taking it out, they're 3-4% a year, they think that's all they have to deal with. But Cynthia, at the end of it, it has to be all gone within 10 years. So potentially you have this massive tax implication right at the time when you don't want to have it.
Yeah.
A Roth is excluded entirely from that, other than it has to be exhausted within 10 years. So if you can grow this money tax-free for 10 years and then take it out in a lump sum 10 years from now, isn't that a lot better than paying all of these taxes, these concurrent life expectancy? Honestly, I've never even heard of that. It's the craziest thing. The ruling is a disaster.
It sounds like it. Absolutely. Well, I have to ask you a question before we go to the phone line,
Yeah.
Stewart. What happens if you don't take your RMDs?
That's the big one, right? We have a lot of people that don't. You hear about the story about, hey, I inherited this IRA as a non-spouse beneficiary. I'm a child of my parents, and they'll say, well, why didn't you take your RMDs? And they'll say, no one sent me a letter, but the insurance company or the financial company will say, no, we sent you a 1099, and a lot of times people don't realize what that means for them, right?
Yeah.
It's a 50% penalty for all the money you didn't take. So,
wow.
There's no benefit. We had this really kind of smart guy that came to one of the workshops we did a few years ago, and he said, hey, you know what I'm going to do is I'm going to defer it out. I'm not going to take them, and then I'll take it in a lump sum at the end, not realizing that there is a 50% penalty for each distribution you were supposed to take. So there is no tax planning that I can do for anybody that's going to make up for a 50% penalty.
Wow.
So you have to take it or you're going to get penalized.
All right. Thank you so much. Well, Stewart, I know that you and Dan have a very special offer to present to the viewers at home. Let's talk about what that is before we open the phones.
Absolutely. What we're offering today is a complimentary portfolio review. If you take action today, give us a call at 833-652-7829 or pick up your phone and click on that QR code there at the bottom of your screen. What we're offering today is that complimentary portfolio review where we'll take a look at all the risks that you're taking, the taxes you're paying, and whether or not you're in the right portfolio for you.
Stewart, thank you so much. Dan, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions about how to plan your perfect retirement. Stewart and Dan have the answers for you. Now, speaking of questions, just in case you're wondering what exactly is a Roth, I'm going to ask these gentlemen the moment we return. Stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis and Dan Murphy of the Asset Preservation Tax and Retirement Services. Stewart, I have a question for you. I know a lot of viewers in the audience are probably wondering what this is, and I want to know as well. What exactly is a Roth? Can you explain it to us?
Yeah, absolutely. So, I talk about Roth all the time, and, I'm a little scared of heights, so the building behind me is kind of freaking me out here.
It looks good, though.
No, I'm just kidding.
Like Superman.
So, right? I do. I think so.
I think you do.
No, but what a Roth is, to understand what a Roth is, you have to understand its counterpart, the IRA or the 401k. And a lot of people have done their job. They were told, hey, put away all this money into your 401k or your IRA. You'll get this great tax deduction for doing it, and you'll be able to take this money out later when your income is lower in retirement. And honestly, Cynthia, a lot of that was great discipline to put the money away.
Yeah.
But what we're seeing now is people that have all this money that's put away into these tax-deferred vehicles that, they now realize that, oh my gosh, I've got $1 million. I've got $700,000 in this 401k. And when I take it out, I'm gonna have to pay tax on it. And what people don't think about is that also makes their Social Security taxable. And Social Security was never meant to be taxed. But what the Roth is, on the other hand, is an account that you create. If you do a 401k Roth, for example, you don't get a tax deduction at the time that you put it away, but you get all of its growth and all the principal tax-free when you take it out. It's also basically invisible at this point to Social Security. So your Social Security won't be affected, under any sort of current laws here. But, it's a phenomenal thing because you can spend your entire lifetime letting it grow completely tax-free.
Well, Stewart, if the Roth is a better option overall, why aren't a lot of advisors talking about that with their clients? Well,
I think a lot of advisors realize that it's a better account, but I think there's a couple reasons why they don't. Number one, think about this. Let's say a financial advisor manages $100 million for easy math, and his clients, let's say, are at the average of 24% tax, in the 24% tax bracket. Well, if he goes to every single one of his clients and says, hey, you know what? We need to convert these IRAs over to Roth, they're going to have to pay a 24% tax on that. Now, what does that do? It also reduces, because most people will end up doing a withholding from their 401k or their IRA, and now their $100 million block of business that this manager is managing is now $76 million after the tax bill's paid. So does it make sense? Well, it may, but remember, the advisor just gave himself a 24% pay cut.
Wow.
So it's one of those really kind of tough things, and hopefully most advisors will look past that and aren't just thinking about their wallet, which is why it's really important to deal with a fiduciary. But the other reason is, when an advisor is asked, and we hear about it all the time, clients have been watching our show for years. They'll say, hey, this guy on TV, this goofy guy is talking about this Roth. Tell me a little bit more about it, right? Yeah. And they're not, you would think they were talking about him as the goofy guy, but apparently they're talking about me. But at the end of the day, sorry, man, it's your first time. We've got to haze you a little bit here, Dan.
Right,
welcome to the jungle, big boy. But no, at the end of the day, I think it's really important to realize that the advisors realize that a Roth is better. But at the end of the day, when the person says, okay, well, how much should I, the client says, how much should I convert or how much should I contribute? You know what? You need to talk to your tax advisor about that. So then the CPA, is given the, baton. But then the CPA says, I don't know, man, you need to talk to your financial advisor. And so what happens is the right hand doesn't know what the left hand's doing, which is the entire reason we have a tax office. You know, tax season is a nightmare. It is a lot of work. It's 7 days a week we're working, long days, long hours. But the reason for our tax office, Cynthia, is it gives us these unbelievable tools, the ability to analyze how much exactly should we take out. Because what we do is we always save our tax planning till the end of the year. Unless there's a massive market correction, we generally don't, do any conversions during the year. But in October, November, December, Dan and I and the rest of the tax team will get together, we'll look at somebody's portfolio and we'll say, hey, you know what, we've got $47,000 of room inside the 12% bracket, plus, another 100 grand inside the 22. And we present a list of scenarios that could, basically outline exactly what will happen to the client if everything remains constant, they follow our plan. So we do this amazing tax planning to determine, how much they should do. And back to your original question, most advisors don't have those resources to do that sort of tax planning.
Thank you so much, Stewart. Dan, I have to ask you a question. I want to talk to you a little bit about pensions in our next block, but I want to ask you, can you convert your existing IRA or your 401k to a Roth? Is that an easy process?
Well, I don't know that I'd say easy, but yeah, it definitely is something that we do all the time, and it's a big conversation that we have with our clients. It's really important that through this whole process, clients understand that there's a lot of tools that they have in their tool belt that's available to them, but if they don't realize that they can use that screwdriver, it's really something that can hurt them. And so we want to make sure that we have this conversation and we understand how exactly do Roths, work. And it's also really important to understand you can make a mistake while doing it. We don't need to move everything out of the actual IRA. It's a certain portion, making sure the standard deduction is basically going to cover what that RMD is, and it puts us in a really good tax bracket when we're in retirement. But it's an important thing to know.
Okay, thank you so much.
Yeah.
Stewart, what are some of the steps that you take to determine if a Roth conversion is right for a client when they're sitting with you for the very first time? What type of questions do you ask?
Well, the first thing to do is I have to let people make their own decisions. When I talk about how we make presentations, what we'll do when we come back from break is I'm going to show you what the tax brackets look like and how to maneuver within them. So I think it's first important to educate you on tax brackets, how they work, and how we can most effectively, transition there.
Absolutely. Well, Stewart, I know that you and Dan have a very special offer to present to the viewers at home. Why don't we talk about what that is before we open the phone lines?
Absolutely. So if you give us a call today at 833-652-7829, what we're offering today is a complimentary portfolio review. And in that complimentary portfolio review, what we're going to do is we are going to take a look at what kind of taxes we see in your background there. Do we see any sort of tax time bombs that Dan talked about? What kind of risks are you taking? Are you taking too much risk inside your portfolio? A lot of people have been doing a great job on their own, being self-managers for the last decade, but people are also realizing that the end of this market may be near, and they're now looking for some professional help. If you take action today, pick up your phone, give us a call, or click on that QR code that's right at the bottom of your screen. That'll take you right to our complimentary portfolio review link, and we'd be glad to meet with you.
Stewart, thank you so much. Dan, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We're going to take a very short commercial break, but when we come back, we do have a tax slide for you. And I'm also going to talk to Dan a little more in depth about pensions, so please stay tuned.
This is the story of how you get from here to there. Right now, you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Dan Murphy of the Asset Preservation Tax and Retirement Services. Gentlemen, a great show we're having today, talking about such an important topic, obviously, Roth conversions. And Stewart, I know that there's a tax slide that you want to talk about a little bit in this segment.
Yeah, I think people really have to put into perspective where we are tax-wise right now to understand why it's so important that we talk about tax. The first thing I'm going to do is I'm going to show you a tax bracket slide. And this tax bracket slide is just showing you the makeup for 2022, what the current brackets look like. And the way I approach taxes is going from the 10% to 12% bracket is a small jump. Going from 12 to 22 is a huge jump. 22 to 24 is a small jump, and then 24 to 32 is a huge jump. But Cynthia, what I think you really need to understand is that these brackets all make sense if you just look at the math. The difference, though, is that there are issues in between the 22 and 24% bracket. For example, there's IRMA, and what IRMA is, it's a penalty to Medicare. So, you know, if you're 63 years or older, you need to make sure that you understand that it's not just taxes that you have to worry about. It's these Medicare penalties. There's also the NIIT, which is people call the Romney tax. There's a lot of these sort of landmines out there that you just really need to be aware of to make sure you don't hit them. So that's one thing. But the other thing you should remember, Cynthia, is that we are in the most efficient tax window in history right now.
Yeah.
If you're not making a plan right now for taxes and tax planning, you're going to miss out, and I promise you, you're going to regret it. So let me show you what I'm talking about here. So now we have a comparison tax slide here that will show you the difference between the 2017 tax environment and 2018 Trump tax cuts. And if you take a look at these brackets, in blue, of course, is the Obama-era tax brackets. The red were the Trump tax cuts. Now, these are for married filing jointly, also showing the standard deduction. I think a lot of times people forget about the huge increase in standard deduction because most people used to itemize. Now you don't have to. Most people don't need to itemize. Now, some do, but if you take a look at that 22% bracket today, that was 25 to 28%. The 24% today is 28 to 33%. So we're in this massive discounted window right now, Cynthia. And let me just tell you, if you don't take advantage of that, it's a massive problem. These tax rates are set to sunset here at the end of 2025. So you've got a few more years left to really plan. And if you don't use it, I think it's a tremendous mistake.
Absolutely. So again, it comes down to planning is key.
No question.
Yeah, absolutely. Well, Dan, you've been awfully quiet. I'm going to put you in the hot seat right now for a little bit as well. I want to talk to you a little bit about pensions. Are they becoming a thing of the past?
You know, they really have been. I mean, people still have them if they're working for the state or a variety of different things. I mean, Honeywell is a really big company that's here in Phoenix land area. You know, I always think of my grandfather when you think about a pension. He always said, Danny, make sure you get a really great job that has a good pension. You don't have to worry about anything else. And that doesn't seem to be happening anymore. A lot of the onus is now on, you know, the employee to squirrel away money and save and make sure that that money is there and available. And so it's like, you know, when waters get choppy in this, you know, age, it's really difficult to make sure that you have that money saved up for retirement. So pensions are definitely one of those things. You know, we have all these different options. When we have clients that come in, they have all these different types of options. Are you going to take it in a lump sum? Is this dollar amount going to be something that you're going to take over for a certain period of time? Are you going to take it for a spouse, or is it just going to be for your life? So there's a lot of questions that people come to our office and have questions on, and it's really important to have an effective plan and making sure that the clients understand what it is that they need to do to plan properly if they do have a pension. And kind of to Stewart's point too, when you start looking at the tax, you know, implications, you know, one of the first things we look at when we're delivering taxes is we see a line item of this is the pension money that came in, and that definitely can cause someone to jump into a higher tax bracket. If you have 50, 60, 80 grand that's coming in from a guaranteed pension, and now you got Social Security that's adding on to that, and before you know it, you know, distributions from an IRA that we have, now we're again running into this tax bomb that could happen. So how we utilize our actual pensions or not can really play a big, huge role in how successful we are in retirement.
Sure, and really someone should make a decision like that until they come in and talk to both of you to see what is the right option for them, taking it all at once or having the distributions, if you will. Stewart?
Yeah, absolutely. And the one thing I would just say, Cynthia, is that oftentimes people have to know what is the benefit and downside to taking a pension in a lump sum, rolling it over to an IRA. Now, there are some downsides to it. There's ERISA protections. There's some other things that come with a pension that don't come inside an IRA. So you need to make sure you consult an advisor, which is what we do. But the other thing is, Dan was alluding to this irrevocable income stream. Yes, it's nice to have, but now in most cases for these better pensions, you've just forced yourself into a taxable situation for Social Security when you might not need to. For example, we have a client that works at Honeywell, the great company locally here, and she had an option to delay her pension, and for every year she delayed, there was like a 5 or 6% increase in payment per year. And so she didn't lose anything by deferring it, but what it did do is it gave us a few years to convert all of her 401ks and everything else to Roth. So by deferring that, we were able to convert her IRAs and 401ks over to Roth. That way, her Social Security would be at a lower bracket, and basically she could stay at, right at the bottom of the 22% bracket. But it's a huge deal. It's not about what you make; it's about what you keep.
That is true. Very, very good point. Absolutely. Well, Stewart, I know that we only have a couple minutes left of the show this week. I wanted to ask you, who is your ideal client? Who do you serve best?
Yeah, I mean, the people that I think we click with best are people that have really taken retirement seriously, people that have done their job, that have put their money away, they've spent a lifetime doing their savings, and they realize that, hey, you know what? This is just a little too much for me now. We know that we can put money away, but now what do we do with it? Right? They built up this amazing lifetime of savings. We're not, if you're 18 years old or 30 years old and you're just trying to figure out what to do, honestly, generally the best idea is to put it into some, passive S&P 500 fund, let it ride. But remember, we believe we're closer to the end of this market than we are to the beginning of it. And you don't always want to let those chips ride when you're nearing retirement. You've got to take some risk off the table.
Sure, absolutely. Dan, is there a perfect age for someone to start planning for retirement, in your opinion?
You got to do it as soon as you can, right?
Okay.
But I mean, it's never too late, is what we always tell everybody too. You have to make sure that this is a priority and it's something that's important, and we love helping people develop a plan.
Absolutely. Well, gentlemen, I can't believe we only have 30 seconds left of the show this week. It goes by so fast. So, Stewart, thank you so much for an amazing episode. And Dan, thank you so very much for an amazing episode.
Thanks, Cynthia.
To the viewers at home, most specifically, we'd like to thank you for spending time with us today. That number is 833-652-7829. If you have questions about your taxes or Roth conversions, Stewart and Dan have the answers for you. Don't miss the opportunity to call in today, 833-652-7829. We'll see you back here 1 week from today. Be safe, be happy, and be blessed.